Hello all. So today we are going to start with our chapter number 9, which is on principles of insurance and loss assessment. As per IBBI syllabus, it carries theory marks for 3 marks, theory of 3 marks, and a numerical or a case study may come up to 12 marks in IBBI syllabus. It is very important, simple to understand and scoring chapter. So we have to understand few concepts and we have to remember few things for examination purpose. So we will try to cover all important aspects which can come in the examination. So this is the syllabus as per IBBI syllabus for this chapter, which we will try to cover in this session. So first question is that what is insurance? So insurance is a contract between insured and insurer. So we'll repeatedly use these two terminology, insured and insurer. We'll see who are they, by which the insurer gives financial protection or reimbursement against future uncertainty of losses. So I repeat, insurance is a contract between insured and insurer by which the insurer gives financial protection or reimbursement against future uncertainty losses. So who is insured? Insured can either be individual or entity, and insurer is insurance company. So please remember these two terminologies, that insurer is an insurance company and insured is an individual or entity. A consideration charged by insurer is called premium. Now what are the different principles of insurance? So insurance contracts are subject to certain special principles evolved under common law in UK and are generally followed by Indian courts. These principles are also known as fundamental or basic principles of law of insurance. So broadly, these are the 7 principles out of which a numerical may come based on these principles as well, or a theory question or conceptual question may come out of it. So let us see one by one what are these principles. So first principle is principle of utmost good faith. It is the duty of proposer to disclose all material information, including information which he knows and also he ought to know, to the insurer. So but as a proposer, it is my duty to tell all the facts which I have knowledge of or I am expected to know to the insurer, the insurance company. Based on this information, the insurer decides to accept the risk and the rate of premium and terms and conditions of acceptance. So whatever information I provide to the insurer or the insurance company, based on that the insurance company decides the premium. First their actuary team decides about the level of risk associated with the transaction I'm trying to do with them, and then they decide the premium to mitigate the risk, and accordingly they stipulate the terms conditions of acceptance. So thus the proposer has duty of utmost good faith toward the insurer. So 1 mark theory question can come out of this paragraph. Likewise, the insurer, that is the insurance company, also has a responsibility to act with good faith in all its dealings with the insured. So insurance companies also have certain responsibilities toward the insured under this principle. The insurer cannot mislead the buyer. So first responsibility of the insurance company is that the insurance company or the insurer cannot mislead the buyer in respect of the transaction, but he has no obligation to disclose all information about the subject of the contract. So proposer has obligation under this principle to disclose all information which he knows or ought to know to the insurance company. However, vice versa is not there. The insurance company has no obligation to inform each and everything. There is no obligation on shoulders of the insurance company to inform each and every fact to the proposer. It is the buyer's duty to be careful while entering into the contract. let the buyer beware is the legal rule. So it is an important terminology. So when I purchase an insurance policy, it is my duty to understand the terms conditions of those policies, and I can ask any question, I can ask any information from the insurance company, and they will provide me. So but it is not a onus is not on the insurance company, but at the same time they cannot mislead the buyer, they cannot misrepresent the transaction or misrepresent the facts. Policy purchased through an agent. So what is that, how this principle applies on a policy if it has been purchased through an agent? So in case insurance policy is bought through an agent, the agent has similar duty to disclose all material facts known to him or communicated to him by the proposer. Say for example, I purchase a insurance policy of X company through some agent. So my duty is to inform all information to my agent, right? And agent duty is there, he should inform all duty to the insurance company. So this is how this principle further stipulates responsibility of the insurance agent as well. So let us try to understand what are the material facts, because we use the material facts. So in case of fire insurance, if I'm planning to buy a fire insurance policy, so as a proposer, it is my duty to disclose the cost of construction of building, nature of occupancy, nature of goods stored, etc. So all this information insurance company will ask from me, and based on that insurance company will assess the risk, decide the premium, and fix upon the terms condition of the insurance policy, and accordingly the agreement will be prepared. So in case of marine insurance, I have to tell, as a proposer, I have to tell packing material, which packing material I am going to use, for example single gunny bag or a plastic bag or drum, or nature of goods, hazardous, non-hazardous, etc. Motor insurance, it is my responsibility to tell my insurance company details of cubic capacity of the engine of my car or vehicle, manufacturing year, purpose of vehicle, whether it is commercial or private, carrying capacity, 4-seater, 5-seater, 6-seater, geographical area where the vehicle will be used, etc. So personal accidental insurance in case of, so as a buyer, as a proposer, it is my responsibility to tell my age, height, weight, physical disability, nature of occupation, etc. So I should tell all this information in a correct way to the insurance company. So general disclosures, details of previous losses suffered by the proposer, detail of previous insurer if rejected any claim or charged extra premium on cancelled or refused to renew the policy, etc. So all these details fall under material facts, and all material facts should be shared by the proposer or the buyer with the insurance company insurer. Contractual duty of utmost good faith. Normally insurance company design a proposal form. The proposer fills the form and declares the information. The legal effect of this declaration is that the insurer can avoid the contract if any answer is inaccurate or incorrect, even if the answer is not material to the risk. This is called contractual duty of utmost good faith, which is far stricter than the common law duty. So basic concept is that whenever we purchase, many a time we purchase an insurance policy through an agent, and agent simply asks us to simply put a signature on that application form, and the insurance company do provide us an application form. There are many details which are required to be filled in, but normally we do not fill all the details, and agent simply asks us to sign on 2-3 pages, and he fills the only name, PAN number, basic details he used to fill. So ideally we should go through the form properly, and we should provide all information correctly. So if in any case any information, even if it is not material to the risk, to the policy, so if insurance company at the time of claim finds it to be inaccurate, then insurance company can reject my claim basis that simple very irrelevant kind of information which appear to be wrong in the form and has been caught by the insurance company at the time of claim. So be cautious about the thing. So as per IRDA regulations, protection of policy interest 2002, the duty of disclosure of material information regarding a proposal or policy also applied to the insurer agents and insurance intermediaries. So as per IRDA guidelines, so this duty is also there on shoulders of the insurance company, their agents and their intermediaries also. So whatever material information is there, they also have to disclose it to the buyer and proposer. So next very important principle of insurance is principle of insurable interest. So we should understand what is insurable interest and how to calculate this thing. So one can enter into a valid insurance contract if and only if he has a valid reason to insure an asset, and he stands to suffer a direct financial loss if the uncertain event occurs. So this legal right to insure is called insurable interest. So this 1 mark theory question can come. What is insurable interest? So these two key terms we have to remember to answer that question correctly. Without insurable interest, the contract of insurance is void. So we'll understand the terminology of void, voidable while having theory sessions on law in general, which we will have in subsequent sessions. But it's a void. So we'll see with the help of an example what are the insurable interest example. So these are the examples of insurable interest. For example, ownership or joint ownership of property is an example of insurable interest. I cannot insure, I cannot purchase insurance for car of my neighbor. The car should be owned by me. Only then I can purchase an insurance policy for it. So a bank has insurable interest in the mortgage property to the extent of the loan amount. So any 1 mark question can come out of any of these lines, any examples. So a bank has insurable interest in the mortgage property to the extent of loan amount. Say I have a property of 100 rupees and I have mortgaged that property to the bank against a loan of 60 rupees. So bank is having insurable interest up to 60 rupees. So bank can purchase insurance of 60 rupees against this property. Ship owner has insurable interest in the ship. If I am owner of a ship, I have insurable interest. I can take insurance policy for that ship. Cargo owners, buyers and sellers both. Cargo owners may include buyers and sellers, have insurable interest in goods owned by the owner. So whatever goods are there in my name, so whatever cargo goods are available are being transported through the ship. So for that thing, ship owner cannot purchase insurance, but the owner, actual owner of the goods or cargo which are being transported through the ship, they can purchase insurance for the goods. Owner of motor vehicle has insurable interest in both vehicle and potential third party liability. So this is also important point. So that is why whenever we purchase vehicle insurance, bike insurance or car insurance, we need to purchase third party insurance as well as comprehensive. So both options are available. So vehicle, I can purchase insurance for vehicle because vehicle is owned by me, and also potential third party liability because if a third party gets injured, the damages payable to the third party would be financial loss to the insured, buyer, proposer, owner of the car. So thus he insures his third party liability also. A person has insurable interest in his own life. It is very important statement, and we'll see further details in next slide. Insurable interest in life. One mark theory question can also come out of this slide. So please note all these facts and try to remember. Every man has automatic insurable interest in his own life. So I have insurable interest in my own life. He need not require to show anything to prove the interest in continuation of his own life. I need not to prove it that I have interest in continuation of my life. A spouse has automatic insurable interest in the life of his life partner. I have automatic insurable interest in the life of my life partner. I need not to prove it again with the help of any supporting document. Apart from husband, wife, or any other close relative, any person who has legal right to derive maintenance from a person can take a life insurance policy on the life of the latter the person who has been paying the maintenance, without any proof of insurable interest. This is also an important point. 1 mark theory question can come out of it. And the interest in life may also arise because of some contractual transaction. Some contract is happening between two parties, so it may also lead to some insurable interest. For example, a creditor has an insurable interest in the life of the debtor to the extent of his loan amount. I have given some loan amount to you, right? So I am creditor and you are debtor to me. So if I have given 100 rupees of loan to you, so I have insurable interest up to 100 rupees in your life. So the same rule applies in case of guarantor too. So these are the theory questions. So time when insurable interest should be present. So at what time this insurable interest should be present? Because it's a process. Purchasing a policy is a process. So in case of fire and miscellaneous insurance, so this is also important slide. 1 mark theory can also come out of this slide. In case of fire and miscellaneous insurance, insurable interest must be present both at the time of taking the policy and at the time of loss. For example, if fire happens to an asset with fire insurance after sale of the asset, the new owner shall not get claim because he has no insurable interest in the asset at the time of a loss. So if I want to take claim of fire insurance policy, I need to prove that when I purchased the policy, that time I was having insurable interest, and at the time the actual loss happened, that time also I was having insurable interest. So if under any situation I was not having a valid insurable interest in the asset which has been damaged or lost due to fire under the policy, I cannot claim damage. In case of marine and cargo insurance, insurable interest is required at the time of loss only. So at the time of purchasing the policy, it is not required in case of marine and cargo insurance. However, in case of fire and miscellaneous insurance, it was required both the time. But in case of marine and cargo insurance, at the time of purchasing the policy, that insurable interest is not required. It may not present at the time of taking the insurance policy. An importer may buy marine cargo insurance policy even before the insured goods are being billed to him. So before purchasing the goods, I can purchase a policy, and but at the time of loss, I should have insurable interest in the asset, in the goods, in case of marine and cargo insurance. In case of marine hull insurance, hull means body of vehicle, right? So ship. Insurable interest must be present both at the time of taking the policy and at the time of loss. So this is a confusing part. So in case of marine hull or ship or body of the ship insurance policy, I should have insurable interest at both events, at the time of purchasing the policy and at the time of claim, loss of the asset. However, in case of cargo and cargo insurance, marine insurance, it will not be required at the time of purchasing. However, at the time of loss, the insurable interest should be there. So next important topic on this principle could be assignment of insurable interest. So in case of fire and miscellaneous insurance, insurable interest can be assigned only with the consent of the insurer, insurance company. So if I have a fire or a miscellaneous insurance policy with me, which is purchased from X company, so I cannot assign that insurable interest or policy to a third person without the NOC from insurance company. However, in case of marine cargo insurance policies, these insurable interests can be freely assigned without previous knowledge or consent of the insurer. The reason is that ownership of goods insured under a marine cargo policy gets frequently changed when goods are in transit. So in case of cargo, normally when a ship starts from say A country, and it may take 30-40 days to reach B country, say in case of petrol, oil, crude oil, it starts from Arab, UAE on date 1st February, it may take 25 days to reach to Gujarat port. So during that transit period, a number of companies may purchase some part of the ship or part of that crude oil which is being transported through the ship. So cargo policies, marine cargo policies allow transfer of insurable interest, reassignment of insurable interest without NOC from the insurance company. However, in case of fire and miscellaneous insurance policy, prior NOC from the insurance company is required. And likewise, in case of marine hull policy, assignment cannot be done without consent of insurer. So here also we need NOC from the insurance company. So let us see what are the different types of insurable interest. So basically they are, broadly speaking, there are two types of insurable interest. Number one, contractual insurable interest. Number two is statutory insurable interest. So contractual insurable interest are which may arise on account of existence of an insurance contract. So if I sign an agreement with the insurance company, that agreement gives me, based on that contract, if I have taken a loan from a bank, so based on that contract, it has been some insurable interest have come to me. However, statutory insurable interest are insurable interest which arise due to existence of some statute dealing with insurance. So there is no separate execution of agreement is required. However, whatever laws or statutes are there in the country, they by default give us those insurable interest. So this is the third principle of insurance, which is principle of indemnity. Indemnity means guarantee or assurance given by the insurer. Insurer is insurance company to make payment equal to actual loss or sum insured whichever is lower, to restore or put the insured asset to the same position in which it was immediately prior to the loss. Thus, insurer agrees to pay no more than the actual amount of loss. So basically, it is a guarantee which is being given by the insurance company that it will make good the loss, actual loss, or sum insured, whichever is lower, to restore the insured asset to the same position, whatever position it was just prior to the loss. So this is the principle of indemnity. In case of underinsurance, proportionate claim is being settled. So this we will try to understand with the help of some example. Underinsurance quotient and what is underinsurance, how it affects the claim amount, that we will see in coming examples, and the next session we will have in-depth case studies on underinsurance quotients and case studies. So application of indemnity principle. In case of building, cost of reinstating the building and repairing damaged the building minus depreciation. So this is the cost which we discussed in the last session. In case of machinery, cost of replacement of machinery or cost of repair at the place and date of loss. So here place is also important and date of loss is also important. So the place where the damage has happened, there only replacement cost will be evaluated. So if we shift that machinery to some other place, and because of that thing, if cost of repair of machinery increases, that increase or enhanced cost will not be paid by insurance company. And in case of stock, cost not sale price of stock purchased at current price. So this is how as per principle of indemnity, actual loss is being assessed by the insurance company. So what are the limitations of liability of insurer? So insurer is not liable to pay any amount beyond sum insured mentioned in the policy under any circumstance. What is the maximum amount of sum insured I have taken, or for which I have paid premium to the insurance company? Insurance company under any circumstance will not pay me over and above the insurance cover or sum insured that I have purchased. In case of underinsurance, condition of average will be applicable. So this is an important clause, condition of average. This we will try to understand with the help of example and case study in subsequent slides and next sessions. Thus, proportionate loss shall be payable. Salvage, if any, is property of insurer. Insurer may take over the salvage and dispose it off. So from numerical purpose, salvage is normally considered to be 0 if it is not explicitly mentioned in the question from IBBI exam purpose. However, from practical aspect or practical concept understanding purpose, salvage value, whatever is there, that is considered to be property of the insurer. Some policies are subject to excess or franchises, that we will understand with in next slide. What is excess and what is franchise? What is the basic hairline difference between these two terminologies? So let us try to understand concept of excess and franchises clause mentioned in insurance policies with the help of an example. In both cases, nothing is payable if loss amount doesn't reach the limit. For example, if it exceeds the limit, only excess amount is being paid under the excess clause. However, entire loss is being payable in case of franchises clause. For example, if there are two insurance policies A and B, say we have two policies A and B, and excess clause of ₹1000 and franchises clause of is mentioned in policy number A, and franchises clause of ₹1000 is mentioned in policy number B. So if loss of ₹500 occur, then neither policy A nor policy B, neither of them will pay any amount to the claimant, to the insured. However, if say loss amount is 1100, so in case of policy A with excess clause of ₹1000, ₹100 shall be paid to the policyholder or claimant of policy A. However, in case of policy B with franchisee clause of ₹1000, entire 1100 rupees will be paid. So next principle of insurance is principle of subrogation. So this is also an important principle from examination purpose. Subrogation is the transfer of legal rights held by the most insurance companies to legally pursue a third party that caused an insurance loss to the insurance company, insurer. In case of loss, if insurance company pays the claim to insured and thereafter the insured gets some money from any third party, the said amount to be paid by the third party shall be paid to the insurance company. For example, because of Mr. A, some loss happened to me, and because of that loss, I claimed say 100 rupees of claim to the insurance company. So now insurance company paid 100 rupees to me to make good the loss which I caused because of action of Mr. A. So now insurance company can sue Mr. A and can recover. So that is a right of subrogation. And in case I receive certain compensation or certain amount from Mr. A, so 10 rupees, 15 rupees I receive. So it is my duty to pay back that 10 rupees or 15 rupees to the insurance company. So this is the principle of subrogation. This right of subrogation is being enjoyed by all insurance company and is implied and automatic right, even if it is not expressed in the contract. So this right is being enjoyed by all insurance company, whether insurance company explicitly mention about this right in the insurance contract or not, even then it will be enjoyed by all insurance companies. So next principle is principle of contribution. So if an insured has taken policies covering same risk from two or more insurer, in event of claim, all of the insurer shall pay an equitable proportion of the claim payment. So if I have got my insurance, say I have got my car insurance or my house insurance from two or more than two insurance companies, and some damage happened to my house, then equitable proportionate share will be paid by the all insurance companies. In case one insurer overpays, he has a legal right to recover part of the payment from other insurer which policy whose policy was also applicable. Say I have purchased insurance policy from insurance company A and insurance company B. Say 100 rupees each insurance cover for my house I purchased from both companies. So if a loss of say 50 rupees happened to my house, so ideally I should take 25 rupees claim for each of the company. However, if I take 50 rupees of claim from company A, full claim from company A, and the fact comes to the knowledge of company A that company B was also having same type of insurance cover for the property for 100 rupees. So 25 rupees can be claimed by company A from the company B. This is the principle of contribution. Let us see what are the prerequisites for application of principle of contribution. Next slide. So these are the prerequisites. Application of the principle of contribution is subject to following prerequisites. The subject matter must be common to all policies. So these are the few attributes of prerequisites under which circumstances this principle will be applicable in case of multiple insurance policy for a single asset. So the subject matter or the asset should be common to all the policies. The peril which is causing loss must be common. So the peril because of which loss has happened should be common to the policies, 2 or 3 policies. The interest covered in all policies must be same and must be in favor of common insured. The policies must be in force at the time of loss. Both the policies should be in force. They should not have been expired. The policies must be legally enforceable, so they should not be void or voidable policies. They should be legally enforceable under eyes of law. So all these factors should all these conditions should meet to ensure applicability of principle of contribution. So let us try to understand this concept with the help of an example, and 1 mark numerical can also come out of this principle. Normally this 1 mark numerical normally come if a person has got sum insured of rupees 50,000, 1 lakh and rupees 1.5 lakh from 3 different insurance companies for a same asset. How the claim amount of rupees 1.8 lakh shall be processed? So I have purchased 3 insurance policies for a specific asset of me from 3 insurance companies, and sum insured from company A is 50,000, B is 1 lakh and C is 1.5 lakhs. So if I want to claim my 180 lakh rupees, then what should be the process to how much amount each company will pay? So here in this question, sum insured by first insurer, say A is 50,000, B is 1 lakh, 3 is C insurer is 1.5 lakh. So total sum insured by me for the asset put together by 3 companies is 3 lakh rupees, and total claim amount is 1.8 lakh rupees, right? So what is the proportion of sum insured among ABC companies is 50,000 sum insured by company A, and total sum insured 1 lakh sum insured by B, total sum insured, and for policy C, sum insured by C divided by total sum insured. So 16.67% of the claim amount shall be paid by company A in proportion of their sum insured to the total sum insured, and 33.33% will be paid by policy number B, and 50% will be paid by policy number 3. Since total claim amount is 1.8 lakh rupees, so 16.67% of 1.8 lakh is equal to 30,000 rupees. So under this circumstance, 30,000 will be paid by company A, 60,000 will be paid by company B, and 90,000 will be paid by by company C, and total compensation that will be received by the proposer or insured is equal to 1.8 lakh. Next principle of insurance is principle of proximate cause. This is also a 1 mark theory question can come out of based on this concept. So very important to understand. Each insurance policy defines the events and perils which are covered under the insurance policy. So what is the coverage in terms of perils or events under which circumstances the insurance company will pay the claim, these are explicitly normally been mentioned in the policy. So in case where loss occurred due to multiple events, principle of proximate cause comes into picture. So if any specific event is being caused by multiple events, 2 or 3 events, right? So then in that case, whatever is the proximate cause, so based on that proximate cause, near cause which has caused the loss, based on that claim amount or eligibility for passing the claim will be settled by the insurance company. So we'll try to understand this principle with the help of example in next slide. So it means when a loss is caused by more than one causes, the proximate of the nearest or closest cause should be taken into consideration to decide liability of the insurance company. A person having personal accident insurance policy goes out for hunting and met with an accident. Due to shock and weakness, he was not able to walk, and while lying on the wet ground, he contracted cold, which developed into pneumonia and caused his death. So here multiple events happened. First event, he met with an accident, then he got a shock, then he got weakness, then he was not able to walk, and there was a wetland, and he got pneumonia also on the road, and subsequently he got died. So this case was referred to the court and the court decided in this case that the proximate cause was accident covered in the policy and remote cause was pneumonia. So out of these two events, court held that the person died because of the accident, and accident was the proximate cause, and accordingly claim was payable. Let us take another example where two events were there and claim was rejected. A person having personal accidental policy met with an accident and was taken to hospital. While undergoing the treatment, he contracted with an infectious disease which caused his death. The court held that proximate cause of death was infectious disease and remote cause was accident. So here court decided that the person did not die because of the accident, rather he got died because of the disease which he caught in the hospital. So this claim was not payable under the accidental insurance policy. Last principle of insurance is principle of loss minimization. Under this principle, it is the duty of the insured proposer to take all possible steps to minimize the loss to the insured property on happening of uncertain event. So if my car, I have taken insurance of my car, and if my car met with an accident, some loss happens to my car, then it is my duty to take care of all precautions to minimize the loss, because event has already happened, and I should try that subsequent loss should get minimized. Requirements of an insurance contract. So this is another topic which is important from IBBI examination purpose. So to be legally enforceable, an insurance contract must meet following four requirements. Number one, offer by one party and acceptance of the exact terms by the other party. When an offer is answered by a counter offer, the first offer is void. So this terminology, counter offer, say I have given, company has given me proposal, I have not accepted it. Instead I made some counter offer. We'll understand this counter offer concept in detail in subsequent session on law journal. But for basic understanding, company told me that they want to give me a coverage of 100 rupees against a premium of 5 rupees. However, I told them that I want to have a premium of say 4.5 rupees, 4 rupees for some insured of rupees 100. So that is a counter offer from my side. So the moment I give the counter offer, the original offer given by the insurance company to me is void. It has no meaning, has no relevance. So the element of offer and acceptance. Company should give me an offer and I should accept the exact terms unconditionally. Second important element of insurance contract is consideration. The value, the premium paid by the proposer and accepted by the insurance. So whatever insurance premium the company told me to pay, I accept it as it is and I pay it to the insurance company, and then insurance company accept the insurance premium. Legally competent parties. So the two parties who are entering into the insurance contract should be legally competent to do so, with legal capacity to enter into a binding contract. Minor cannot enter into a contract. So as if I am a minor, I cannot purchase the insurance policy from an insurance company. The contract must exist for a legal purpose. I cannot purchase the insurance for doing murder of a person, for selling a fee. I cannot do insurance of narcotics, cargo insurance for narcotics, because it is illegal. What are the characteristics of insurance contracts? So there are few characteristics. First important characteristic is these are aleatory. So all insurance contracts are aleatory. This means, what does it mean? This means that there is an element of chance and potential for unequal exchange of value or consideration of both parties. For both parties, An aleatory contract is considered upon occurrence of an event. Is conditioned upon occurrence of an event. So I purchase an insurance policy anticipating that my car will met with an accident. That is why I am purchasing that policy. So if I am paying insurance of 10,000 rupees, I am expecting that I am paying 10,000, and if my car, it is likely that my car may met with an accident, and I may claim more than 10,000 rupees from the company. However, the company anticipates that the person who is purchasing the insurance policy will not met with an accident, and if at all it met with an accident, then the insurance claim will be less than 10,000 rupees. So these are the basic understanding by the two parties involved in the contract, insurance contract. So consequently, benefits provided by the insurance policy may or may not exceed the premium paid. So whatever amount I have paid to the insurance policy, it may whatever amount I get from the insurance policy back, it depends on the happening of a certain event. For example, an individual with disability insurance policy will collect benefits if she becomes disabled. So if I purchase a disability insurance policy from the company, I will get some benefits if I get disabled. If I do not get disabled, I will not get anything out of this policy. However, if no disability strike, benefits are not paid. So that is why these contracts are called aleatory. So both insurance and gambling, it is something like gambling contract, are considered to be aleatory contracts. These are also called contracts of adhesion. Now, insurance contracts are also being called a contract of adhesion because insurance contract is prepared by one party. Normally, the insurance company prepares a standard insurance contract and with no negotiation with the proposer. So, if I am buyer of the insurance policy, company will not change it from me normally, whatever standard policies we have in the market. Thus, the proposer adheres to the terms of the contract and on a take it or leave it basis. So if I want to purchase a health insurance, or if I want to purchase a car insurance for my car, so I will approach to the company. Company will give me its standard contract and will explain me standard terms, conditions and features of the product. So it is up to me whether I want to purchase it or not. I cannot ask company to change that policy for me only, and company will not change it. So I have to purchase it on the basis of take it or leave it, and accept it as it is without any conditions. So any confusing language in the contract of adhesion would be interpreted in favor of the insured. The purpose is to correct any advantage that may result from the party who prepared the contract. Since insurance company used to normally prepare these insurance contracts, so it is also mentioned in this thing, in this insurance policy contract thing, as per law, it is mentioned that if any dual meaning words or dual meaning statements are given in the contract, and which may have multiple meanings, so the meaning of the statement or word or interpretation of those language subsequently at the time of claim will be done in favor of the buyer, in favor of the proposer or insured, because the contract was originally prepared by the insurer. Next, insurance contracts are unilateral because only one party, normally the insurance company, makes any kind of enforceable promises. So let us understand, insurer promises to pay benefits in case of loss, but the insured or proposer doesn't make any promise to pay future premium or not. So if I have purchased a car insurance from a company X, say, so company has given me a promise that till validity of the insurance policy, company will make good my loss under the insurance policy as per terms conditions. However, I do not give any guarantee or promise to the insurance company. Then next year also I will purchase insurance policy from the same company or not. I may purchase the insurance policy next year, I may not, number one. And if at all I want to purchase, I may not purchase the insurance policy from the same company. So there is no commitment from my side after making payment, but however, till validity of the insurance policy, the insurance company is having foundation, as having obligation, as having commitment towards me for making good the loss as per the insurance contract. However, if future premiums are not paid, the insurer can terminate the insurance policy. So if I have taken an insurance policy on monthly installment or quarterly installment or maybe half yearly installment, and I fail to pay those quarterly or half yearly installments as per terms of the agreement, then insurance company also go away with the duty of paying the losses under the insurance contract. So the company will not have any liability towards me or my loss to make good the loss. Next characteristic of insurance contract is they are conditional. Insurance contracts are conditional. That is, the insurer promises to pay benefit on occurrence of certain event and on performance of certain events by insured, like timely payment of premium. So here two things are there. First, certain uncertain some event should occur which has been mentioned in the policy, and certain activities insured should perform, right? For example, timely payment of premium in case of monthly, quarterly payments. So these two conditions should get fulfilled, then the insurance company will be liable to pay the make good the loss. Waiver: if an insurer may give up his legal given right, whatever rights the insurance company has as per the insurance contract, the insurance company may give up any contract, any right, but once a right or condition is waived by the insurer, it cannot deny claim on the basis of said conditions. Say for example, I'm planning to buy an insurance policy from a company, and I requested the company to make some amendments in one or two condition. For example, in case of large insurance policies, insurers normally customize their insurance policies. When we go and purchase insurance policy for big machineries, so people tend to negotiate with the insurance company, and the insurance company also consider make customized insurance policies for those companies, for those assets. So once insurance company has agreed for waiver of any condition, any legal right, so then based on that waiver, subsequently insurance company cannot deny payment of claim to the proposer. Void: insurance contracts can be void or voidable as also. So an insurance contract can either be void. So in detail we will understand these two terminology, very important terminology, void and voidable, in law journals. In subsequent sessions we have. For just basic understanding, void means contract which is not enforceable in law, and voidable which can be put to an end by some of the parties involved in the contract. So void is void ab initio. The moment we have signed an agreement and it is void, it has no meaning, so it is void. And voidable, the parties, it is not void, but the parties involved in the contract have option to make it void. So insurance contract can either be void or voidable. So next, let us understand what are the duties of insurer, insurance company. First duty is duty to defend the insured. So it is the duty of insurers to provide an insured with defense to claim made under a liability insurance policy. Duty to gain the insured's cooperation. It is second duty. It is the duty of insurer to maintain good relationship with the insured. Each party must be able to rely on one another and abide by the guidelines at their end. Third duty is duty to good faith, duty of good faith and fair dealing. The insurer, insurance company, has a duty to deal fairly and in good faith with its insured. The duty at the time of entering contract is to provide all details of coverage, timely issuance of policy, fair dealing and support at the time of claim. So these are the duties of insurance company. So other duties are duty to settle claims or pay benefits. Once issuer, insurance company, reviews the claim and find it qualified, it is the duty of the insurer to pay for it. Privacy protection. It is the duty of insurer, insurance company, to protect the privacy of the insured. Risk assessment. It is the duty, again duty of insurer, insurance company, to assess risk associated with each insured and fix premium accordingly. Reserve for policy. Insurer need to keep certain amount aside for policy reserve. This will help the insurer to pay potential amount of claim. So whatever future claims are likely to happen, as an insurance company, it is a responsibility of the insurance company to put aside certain corpus to make payments of the future likely claims. Duty to inform. In case the claim is not admissible, it is the duty of the insurance company to inform the insured, giving reasons. Obligations of insurer. Should not follow unfair claim settlement practices. Insurance company should not follow any unfair claim settlement practices. Misrepresenting facts or policy provision to the claimants. Failing to respond to communication about claims within reasonable time. So whatever communication should be done, and within SLA or TAT, what is the prescribed TAT, within that TAT, insurance company should intimate me. Failing to follow reasonable standards for prompt investigation and claim processing. So whatever agreed TATs are there, so the company should process my claims and do whatever investigation they want to do. Failing to allow or deny claims within a reasonable period of time. So either company has to say okay to my claim or say deny to the claim within reasonable time and with suitable justification. Duties of insured, like insurer has some duties and obligation, likewise insured also have some duties. So obligation to pay premium. While purchasing a policy, it is the duty of the insured to pay premium. So if I am purchasing a property policy, it is my duty to pay the premium. However, this is subject to condition like free look period. So normally when I purchase a policy, I get, after getting the policy document with me, I get a 15 days of cooling period, of free look period, during which I can return the policy and get my money back. Even if the insurance is procured on credit or procured with a promise to pay the premium, coverage may exist even though actual payment has not been paid. So even if I purchase a policy through the credit card, or I have made a promise that I will pay the premium in installments or quarterly, monthly installments, even then that claim, I am eligible to ask for my claim from the insurance company. Notice of loss. It is the duty of insured to timely intimate the insurer about the loss claim with sufficient information to enable the insurance company to investigate the claim. So if any damage happened to my asset which has been insured under the insurance policy, so it is my duty to timely and inform the insurance company about the loss, and whatever documents are required to be submitted to the insurance company, I should submit all documents along with the relevant information to the insurance company. Provide proof of loss to the insurer. Insured has to provide the documents in support of the loss occurred. So if I am submitting a claim to the insurance company, it is my duty to submit all supporting documents justifying the loss which has been caused to me. Cooperate with the insurer. So I have to cooperate with the insurance company and his surveyor also. Liability insurance policy normally have cooperation clause. Thus insured has to cooperate with the insurer and the surveyor. So with the insurance company and his surveyor, I have to cooperate in all terms. Duty to observe utmost good faith. It is the duty of insured to disclose material information. We discussed the material information examples in previous slides. So avoid concealment and misrepresentation. In cases the insurer can void, in such cases the insurer can void a policy, especially if company can show it would not have been issued policy if it had known the fact. So at the time of purchase of the document insurance policy, it is my duty to disclose all material fact which I know or I ought to know. And if subsequently company get to know that I had concealed some information or misrepresented some information, and so company can reject my claim in future. So it is my duty to inform all the information. Avoid collusion. The insured should not collaborate or collude with the third party claimants to influence the availability of insurance coverage for the claim against it. Keep your information current. So if I have taken a policy from a company and if I move from one place to another, I change my address or residence or change your beneficiary, then I have to inform all those information up to date with my insurance company. So keep down exposure to risk. If insurance company discover that you have been behaving recklessly in a way that could increase your chances of a claim, it may consider discontinuation of your insurance coverage. So if I purchase a car insurance and I'm a reckless driver, and insurance company understand that the fact that after purchasing the insurance I am driving recklessly, so insurance company can cancel my insurance policy. Duty to protect insurer's right of subrogation. Right of subrogation we discussed in the last slides. So insured must take care of this right of insurer. So next topic as per IBBI syllabus is fire insurance. So it is the insurance contract which take place against fire and other risk which are mentioned in the fire insurance contract. So they are basically multiple type of fire insurance policies. So these are the major 7 type of insurance policies, and numerical 1 mark theory question can come out of any of these policy regarding the definition. So let us understand what are these 7 type of policies with the help of some subsequent slides. So first is agreed value policy. In this policy, value of item insured is agreed upon at the time of taking up the policy, and the insurer agrees to pay the predetermined amount if their subject matter, the item which is insured, asset which has been insured, gets destroyed or damaged by fire. So here value of the asset is being decided between the insured and the insurer company, insurance company, in principally upfront. So the principle of indemnity, lower of actual loss or sum insured, which we discussed in previous slides, is not applicable on this policy. So this is important 1 mark theory question can come out of it. The principle of indemnity applicable on agreed value policy, not applicable, maybe applicable, not applicable. So likewise multiple combination can be given. So please make note of it. This principle doesn't apply, principle of indemnity doesn't apply on agreed value policy. So the agreed value may be more or less than the market value at the time of actual loss. So normally this policy is being purchased for assets whose value cannot be assessed. Market value cannot be, for example, artifacts, arts, coins, manuscripts, etc. We'll see this in subsequent slide also. So these policies are generally issued for goods and properties whose value cannot be detrimental after their loss. These goods may include work of art, jewelry, painting, etc. Next type of fire insurance policy is specific policy. Under this policy, the risk is insured for a specific sum. In case of loss of property, the insurer will pay loss up to that specific amount even if the asset is underinsured. So here underinsurance caution will not be applicable. That we will see in next slide. What is that? So for example, if a specific insurance policy of rupees 50,000 is taken for a property having value of 80,000 rupees. So my house is having market value of 80,000 rupees and I take a policy for 50,000 rupees. So in case of loss up to 50,000, the insurer will pay full amount of loss. So if I have a house worth rupees 80,000 rupees, so ideally I should purchase insurance for 80,000 rupees. However, I purchase insurance policy for only 50,000 under specific policy category. So if loss happened, any loss happened to my car, and that amount of loss is say 40,000 rupees, so I'll get entire amount. If the loss is 60,000 rupees, I will get only 50,000 rupees. So in case loss exceeding 50,000 rupees, loss above 50,000 shall not be paid by the insurer, insurance company. Thus actual value of property is not taken into consideration while processing the claim. So this is again 1 mark theory question can come, that in case of specific policy, actual market value is not considered. There is no calculation of under insurance quotient. Third type of policy, fire policy, is average policy. Here there is importance of under insurance. So average clause is mentioned in the policy, it is called average policy. If this clause is mentioned in the policy, then it is called average policy. Average clause means that if policy is underinsured, then proportionate claim is being paid by the insurance company. For example, if an average policy of rupees 50,000 is taken for a property having value of 80,000 rupees, as we discussed in the last slide. So property value is 80,000 rupees. However, I took a policy of 50,000 rupees with mention of average clause in the policy, and if loss of 40,000 occur, right? So in that case, I will get a claim of 50% because 40,000 loss has happened. So that means 50% of the property value has been lost. So 50% of the property value has been lost. So 50% of the sum insured I will get. So likewise, the claim amount paid by the insurer shall be equal to loss amount, claim amount 40,000 rupees, and the sum insured divided by total value of the property. It is called under insurance quotient. We will understand this concept with the help of further examples and case studies in next session, which will be on case studies, and this concept is very important from the point of view of calculation of numericals and case studies. So I will get 25,000 rupees of claim under this scenario if I have purchased an average policy. Next type of fire policy is floating policy. A floating policy is taken up to cover the risk of goods lying at different places. So if I have a business model where I keep my goods at different locations, different warehouses or in transit, so the goods should belong to same person. This is the keyword, and only an average clause is always applicable to these policies. So we cannot purchase specific floating policies. So average clause is always applicable in case of floating policies. So these policies are useful for businessmen who deal in import and export of goods and goods lying in multiple warehouses at various locations. And the premium charge is generally the average of the premium that would have been paid if specific policies would have been taken for all these goods. So had I taken specific policy for each of the items lying in multiple, say 4, 5, 6 warehouses, so whatever average premium of those specific policies is there, so that will be equal to the premium of the overall floating policy. Next is comprehensive policy. A policy may cover all type of risk including fire. So including in addition to fire, if other risks are also covered in the policy, it is called comprehensive policy. A policy may be issued to cover risks like fire, explosion, lightning, burglary, riot, labor disturbances, etc. So this is also called all risk policy. 1 mark theory question can come. Comprehensive policy is also called all risk policy. Consequential loss policy. Break of fire may disturb the work in a factory. Production may go down or even stopped while the fixed expenses continue at the same rate. So this policy covers up these consequential losses or loss of profit. So basically, if I have taken an insurance policy for a factory or my machinery, so if some unfortunate event happened to the factory or machinery, then I will not be able to start production of goods into my factory, and it may cause loss of revenue and subsequent loss of profit to me because of non-operation of my factory. So to make good that loss, to cover up that loss, I may like to purchase consequential loss policy. The loss of profit is calculated on the basis of loss of sale. Reinstatement policy. This is also important policy from the perspective of case study. In case study, examiner may give you type of policy that it is average policy and reinstatement policy. So you should understand, if it average policy, then we have to use under quotient formula. If it is reinstatement policy, then we are not supposed to make deduction for depreciation. So if we know the conditions or clauses of the policy with the name, only then we will be able to solve the case study of 12 marks. So we should have thorough understanding of all these type of policies. Here the underwriter provides compensation on the basis of market price of the property minus amount of depreciation till date. However, in case of, normally this is happen in the policy, but in case of reinstatement policies or policies with reinstatement clause, there will not be any deduction for depreciation. So whenever in the numerical it is mentioned that the insurance policies with reinstatement clause, so we are not and we are required to calculate the insurable amount or claim amount payable, then deductions for depreciation will not be made. So it is like a zero debt policy kind of. Conditions for getting fire insurance claim. So there are two basic conditions. There must be an actual loss, and fire must be accidental and non-intentional. Period of fire insurance. Fire insurance policy can be purchased for 1 year only. It cannot be purchased for 2, 3, 5 years, 6 years. So after one expiry of 1 year, I can renew it policy on annual basis. Payment of fire insurance policy, I can make payments in lump sum, upfront, annual premium can be paid, or in installments, monthly, quarterly, half yearly. What does fire policy cover? It covers buildings, machineries, accessories, stock in trade, and contents including furniture. Next type of policy is standard fire and special peril insurance. In short form, it is called SFSP. So this short form may come in the exam from examination purpose. So these policies are designed to cover loss or damage to building, plant and machinery with accessories, stock with work in progress, and contents including furniture, etc. due to fire and act of God perils. So this is the important terminology, keywords we should remember: due to fire and act of God perils. So these are the basic act of God or fire. So fire, bushfire, lightning, explosion, implosion, aircraft damage, missile testing, all these things are covered. Leakage from automatic sprinkler installation, riots, strike, malicious damage, storm, tempest, flood, inundation, hurricane, cyclone, RSMD. This is a short form. Please remember this thing: riot, strike, malicious damage. RSMD. 1 mark theory question can come out of this thing. What is RSMD? Then STFI. This is also there. Impact of rail, road vehicle or animal belonging to third parties. Subsidence means sinking of an area of land. Landslide including rock slide. These are also covered in SFSP. Bursting and or overflowing of water tank apparatus. Any insured peril resulting from pollution or contamination. Pollution or contamination resulting from any of the above perils. This is the list of general and significant exclusions in SFSP policies. So 1 mark theory question can come out of these things. So we have to go through these points and we have to remember 1 mark theory question can come. So items like bullion or precious stone, gemstones, art items exceeding rupees 10,000, manuscripts, plans, drawings, securities, obligations or documents of any kind like stamp, coin or paper money, check, accounting books, computer records, etc. Are not covered in these policies until unless these are specifically declared and covered. If these are specifically mentioned, then only are covered. If policy is silent, then these are not covered. Cold storage stocks due to change of temperature may be covered as an add-on, but this should be explicitly mentioned. Loss of damage of boiler, economizer or other vessels, machinery or apparatus in which steam is generated. So boiler, this 1 mark theory question can come by its own explosion or implosion. These may be covered by some extra, so this should be explicitly mentioned, otherwise these are not covered in this policy. Loss caused by centrifugal force. 1 mark theory question can also come out of this statement. Centrifugal force or outward force on a moving body, but we can cover as an add-on. And most important point under this slide is that loss of any electrical or electronic machine and its part due to overrunning excessive pressure, short circuiting, self-heating or leakage of electricity including lightning. These things are not covered even if extra payment has been made with the intent to cover these risks. This is the list of perils which is not covered in SFSP policies. So earthquake and volcanic eruptions and other convulsion of nature, forest fire, loss by spoilage resulting from retardation of any process caused by operation of any insured peril, war and its allied peril, nuclear and allied peril, pollution or contamination, aircraft damage arising out of pressure waves, loss by theft during or after occurrence of insured peril, coastal or river erosion. RSMD, riots, strike, malicious damage, loss arising out of, total or partial cessation of work, permanent or temporary disposition resulting from order of the government, permanent or temporary disposition resulting from unlawful occupation by any person, theft, larceny means theft of private property or omission by any person in a malicious act. Losses and expenses not covered in SFSPR. So these are also important terms. So 5% of each claim subject to minimum of 10,000 rupees resulting from lightning, STFI and subsidence, landslide, rockslide, etc. act of God is to be deducted. So up to 10,000 rupees or 5% of the claim amount is being deducted from the claim. Rupees 10,000 in respect of all other perils are deducted from the claim. Expenses incurred on architects, surveyors, consultant, engineers fees in excess of 3% of the claim amount. So up to 3% of the claim amount can be paid for against these expenses, but beyond that will not be paid. Removal of debris in excess of 1% of claim amount. Up to 1% claim of the claim amount can be paid for removal of debris. Loss of earning, loss of delay, loss by delay, loss of market, or other consequential or indirect losses or damages of any kind are not covered expenses in the SFSP policy. So these are the standard exclusions. If building is insured or building containing the building which is insured or building containing the insured asset remain unoccupied for a period of more than 30 days. So it is also important point from examination purpose. So if a building which is insured remains unoccupied for more than 30 days, or asset in which building in which assets are kept remain unoccupied for 30 days, then beyond 30 days any loss happening because of non-vacancy or vacancy of the property, non-occupation of the property, will not be paid by the SFSP as per normal terms condition. Loss or damage caused to insured asset by its own fermentation, it is also important. So if any loss is happening to the asset because of the own fermentation, natural heating or spontaneous combustion, then these losses will not be paid by the company under this policy normally. Loss or damage caused to insured asset by its undergoing any heating or drying process. Any heating or drying process is happening, even then the loss will not be made good by the SFSP insurance policy company. Add-on covers on SFSP. So there are certain add-on which I can purchase as a insured proposer. The proposer can opt to seek to cover in respect of following perils expenses at inception. So at the time of purchasing the policy, I can make some extra payment of extra premium, and I can purchase some additional add-ons. What are these? So fees charged by architect, surveyor, consultant, engineer, etc. in excess of 3%. So up to 3% it is allowed in the normal policy, but if I want to cover expenses more than 3%, then I have to make extra premium. Likewise, cost of removal of debris up to 1% is covered in normal policy, but if I want to have claim of more than 1% of the claim amount, then I have to make certain extra premium. It's like in case of car insurance, we make some add-ons, a depreciation add-on or consumable or theft or lost key add-on. So likewise, we can also have some add-on in the SFSP policy. Deterioration of stock in cold storage premises due to power failure which happened due to an insured peril. So this is also important from theory example, the 1 mark theory IBBI exam. Deterioration of stock in cold storage premises due to change in temperature. It can also be purchased by paying extra premium. Arising out of damage of cold storage machinery due to insured peril and forest fire. Impact damage due to insured's own rail, road vehicles, forklift, cranes, stackers, and articles drops from there. So this can be purchased as an add-on. Spontaneous combustion. In the normal policy it is not covered, but as an add-on we can take. Omission to insure additions, alterations or extension. That is, this add-on provides protection for additional machinery, plant and building, plants or building that insured may acquire in the future. So future, if I want to purchase some machinery or building from building in future, so I can take some insurance policy for that future purchase of machineries. Earthquake, spoilage, material damage cover. So damage to machinery, containers, equipments, including cost of removal of debris and cleaning, leakage and contamination cover. Loss of rent clause, insurance of additional expenses of rent for an alternative accommodation, startup expenses and terrorism. So these are the add-on covers which I as a proposer I can purchase along with my policy at the time of purchasing the policy by paying certain extra premium. So let us understand the concept of sum insured. A property can either be insured on depreciated cost, which is market value, or replacement cost basis, which is called reinstatement basis. We did understand the reinstatement without depreciation. In order to get better protection, a policy with reinstatement clause is recommended. So if I want to have better protection, so I should always buy reinstatement because it is zero debt without depreciation. So the sum insured selected should be adequate for the reinstatement. So in case of policy with escalation extension clause, if during policy period value of property increases due to factors like increase in prime cost, exchange rate, etc., which are beyond control of the proposer, so the corresponding sum insured may be increased up to 25% maximum by opting for the escalation extension. So if I have purchased a policy with escalation extension clause, and during the period of the insurance policy validity, the price of the asset increases, market price, because of that currency exchange or some other prime cost increases. So insurance company will settle by claim, will consider a higher cost of the asset up to 25%. So similarly, if any reduction happens in the sum insured during the policy period, so it may insurance company may refund the premium on short period basis. How to decide sum insured under fire insurance policy? So ideally sum insured should represent market value of the property or asset. If more than one property is to be insured in a single policy, then value of each block should be provided and divided into building, furniture, fixture, plant and machinery, valuable antiques and precious metals, and any other item. So in case of building which are fully constructed, so value of sum insured for these buildings can be calculated with the help of any of these two following formulas methods. So first method is depreciated value method. Here estimated cost of reinstatement material plus labor of similar property as on date of proposal at the insured site is calculated. Then we add suitable escalation for the policy period, and then we reduce deduction for the depreciation for the age. So RCN minus depreciation plus escalation for the policy period. So in case of reinstatement value method, here we do not make, because the reinstatement clause is there, so it's a zero type policy, so no deduction for depreciation will be done. So here we will calculate insurable sum insured for the property is equal to estimated cost of reinstatement of similar property as on date of proposal at the site, at the insured site, plus suitable escalation for the policy period, plus suitable escalation for reinstatement period which may extend beyond policy period. Thus this policy will pay in event of loss, damage without any deduction for depreciation also, without any deduction for depreciation. So if my policy period is say 1 year and my reinstatement, my claim period or reinstatement period is say 1 year 15 days. So for additional 15 days I have to make adjustment, I have to make provisions, and I have to make a suitable inflation escalation in terms of the cost of the building. So if building is under construction, then sum insured is equal to total value of building, total value of material and building is estimated. So it is equal to estimated total complete value of the building with material and labor. In case of furniture, fixture and fittings, the sum insured is either market value or reinstatement value basis. In case of plant and machinery, so again two methods are there, depreciated value method and reinstatement value method. So in case of depreciated value method, value of sum insured, amount of sum insured of the machinery will be equal to landed cost of machinery after inflation. So whatever cost as a company have incurred for installation of the company of the machinery has also been added and also been paid and can be capitalized in the balance sheet. So that is landed cost with inflation minus depreciation for the age. And then reinstatement value of the method, here deduction for depreciation is not done, so landed cost of machinery after inflation, so we do not make any deduction for depreciation. Valuables, antiques and precious metals. So since the market value of these items cannot be assessed, so aggregate value policy normally we purchase for these items. Any other item is being done on the basis of aggregate valued basis. So adequacy of sum insured. Sum insured should neither be overinsured nor be underinsured. So what is overinsurance and underinsurance? Overinsurance is a situation where an insured has bought so much coverage that it exceeds the actual cash value or the replacement cost of the risk of property insured. This extra premium is being paid and no benefit would be derived out of it. So my car, I have purchased a car of rupees 10 lakh rupees and I want to purchase insurance for 50 lakh rupees. There is no point in paying extra premium for that extra 40 lakh rupees. I have a house which has a value of 1 crore rupees and I want to purchase a house insurance 10 crore rupees. So I am paying extra premium for no good to me. In case anything damage will happen, so company will not pay me more than 1 crore rupees of property value, which is actual market value, in spite of the fact that I have paid premium for 10 crore rupees of the property insurance. Under insurance, it should not be under insurance. It is a situation where inadequate insurance coverage is being held by the policy holder. So if my property value is 1 crore rupees, but I have taken insurance policy for only 50 lakh rupees, so that is called under insurance. So that is why calculation of sum insured is very critical at the time of purchasing the policy. So in case of partial loss of asset, condition of average apply under insured policy. So we have already discussed the concept of average policy in previous slides, and we will see in subsequent in next session with the help of example also. So claim to be paid out by the company will be equal to claim amount, whatever claim I have done, I have claimed, and sum insured divided by current value of the asset. It is called under insurance quotient. So if I have say my asset value is 1 crore rupees, property value is 1 crore rupees. I have taken insurance of 50 lakh rupees. It is under insurance. So under insurance quotient is 0.5. So I have taken cover for 50% of the value of the asset. So if I incur a loss of say 10 lakh rupees, so out of 10 lakh rupees, 50% will be paid by the company, which is equal to 5 lakh rupees. So we'll see examples in next session. So here payout is equal to amount paid out by the policy. Claim amount claimed against the policy after a loss. Sum insured is the maximum amount to be paid by the policy, and value of policy, current value is value of the policy should be insured for. SFSP claim process. What is the process of submitting a claim? So first inform losses or damages immediately to the insurance company so that the competent surveyor can come to the ascertain the losses. Then give estimated figures of damages. Or proposer has to give, insured has to give details to the insurance company. Then insured has to cooperate with the surveyor by giving them all necessary documents for assessment of the loss. Then cooperate with the insurer. Proposer or insured has to cooperate with the insurance company and its surveyors in all his activities like entering into the premises, taking possession of properties, sorting, removing, etc. without any prejudice. So then last insured has to give all information about all other insurance policies existing on the property at the time of loss to the insurance company. What are the documents required for filing the SFSP claim? Duly certified copy of the insurance policy along with schedules and endorsement, duly filled claim form, newspaper report of the incident if there is any, photographs, and previous claim experiences. These are the add-on documents, additional documents which are required in case of fire claim. So report submitted by the internal committee which was constituted for investigation of the cause of the fire, fire brigade report, FIR, first information report, letter of intimation to police station duly endorsed, or police panchanama. Either of these three documents is required. Forensic reports on sample collected from the affected site. So that report is also required in case of fire claim. Final investigation report is also required, and meteorological report is also required. So please note that in case of explosion claims, factory inspector report is also required. So this is also 1 mark theory question, sometime comes in IBBI exam. What is fidelity policy? We should know. It protects the company from financial losses in the event of breach of trust by an employee. So that's all about 3 marks theory chapter of insurance, principle of insurance, that we have covered fully. Session was little bit lengthy, so before I tell you what we are going to have in next session, I would request you to please subscribe to the channel and click on bell icon so that you will be immediately notified about the next session which I am going to upload soon. So in next session we are going to discuss about examples and case studies which may carry up to 12 marks in IBBI examination, and up to 20 marks can also come, but normally not more than 12 marks doesn't come because other topics are also there. So 8 marks to 12 marks case study can come out of it. So we'll see how to calculate insurable value under insurance quotient, excess, franchisee. So whatever concepts we have learned in today's session, we'll try to apply all those concepts in case studies and example in next session. Thank you.